Thanks everyone for joining on a Friday afternoon. As we come to expect, as we set this webinar up, the SBA decided to drop about 80 pages of guidance out there. So we've had to scramble to try to update as much as possible. We are doing our best to stay on top of what has become a lot of information, especially regarding tax relief provisions and additional PPP information that has come out. Bill's going to drive most of this due to the fact that it is really focused on tax. Really quickly, I'll do my best to get in the way of Bill periodically so we can take a drink of water. But it really will be Bill kind of driving this. Really quickly, one of the founding partners of FML. FML is a regional accounting firm headquartered in Glastonbury with offices in Enfield and smaller offices throughout the state. We're over 85 people, 13 partners, and have a strong focus recently on all of the COVID and PPP related activity. We have a website page dedicated to it. Bill and I have become worldly famous for our webinars, and so we're so happy to be able to entertain you for an hour on a Friday afternoon. Hopefully you have a beverage in front of you and you enjoy the presentation. Bill, why don't you introduce yourself and let's get going.
Sure. Thanks, Frank. So for those of you that haven't attended any of our webinars before, my name is Bill Claffey. I'm a partner on the tax side. I'm an attorney by trade, but I've been in the accounting world since I passed the bar exam. I generally focus on state and local issues and tax credit and incentive issues and audit controversy issues. But as we put together our COVID task force back in March, this was obviously a good fit for my background. And so Frank and I have done a number of these webinars going back to late March, early April. And so anyway, we gave a presentation on the Consolidated Appropriations Act. I want to say it was like the 23rd or the 22nd. It was a couple days before Christmas. At that point in time, Frank, we can go right to the first slide there. At that point in time, the law had been passed by Congress, but President Trump had not signed the legislation. He has since signed that legislation on December 27th of last year. There we go. Yep. And so we're going to focus on tax, but yet we can't escape the PPP here, especially in light of the guidance that Frank mentioned yesterday, and just the importance of the provision for a lot of the folks here on the call. So I organized it in these following in the table of contents here. Right, we're going to go back through and some of this is going to be a little bit of a rehash. I'm going to try and blow through it quickly because I really want to focus my attention on a couple on the employer retention credit, which we talked about on the 23rd, but really dive in a little bit deeper on that, as I just think it's such a critical matter for many folks in the audience here. And I do want to go through some of the additional PPP provisions that came out, some of the clarifications, having a little bit more time to kind of sift through the guidance and kind of get it more organized in my head as it relates to the CARES Act. But we'll go through the other tax provisions and we'll kind of go through that in orderly fashion. So Frank, we can probably just go right to the second slide there. So these are the economic impact payments. Those were, what you probably heard about mostly in the news early on, and this is your very similar to what came out via the CARES Act. It's your $600 payment that's coming through as an advance credit. One thing to note is that the Treasury has given themselves now, in light of all the events of the last few days, I don't know if they'll stick to that, but they had given themselves an internal deadline of January 15th to basically get the check into your hands, right? So to send the check of this stimulus to individuals. Otherwise, it's going to have to be claimed as a credit on your 2020 1040. Now, whether they hold true to that January 15th deadline or not, I don't know. But it's just very similar to the old program. It's $600, $1,200 married filing jointly. You do get an additional $600 per qualifying child. There's a phase out, and I think we went through that in the last in the last presentation. But there is a phase out mechanism here. So if you're over the $150,000 married filing jointly or $75,000 as an individual, you're going to have a phase out of that. That's really it. I know we're going to really focus more here on the business. I just wanted to make sure I mentioned that. Okay, so let's get into some of the loan and grant programs that also have a tax impact here as well. So as many of you may recall, there was the economic disaster loan program that was brought forth in the CARES Act, where it basically expanded disaster zones to basically every state in the country. That program has always been in place. It was typically used by folks that were subject to a hurricane or tornado or some sort of other some sort of other disaster. So a lot of folks went out there and they received grants. There was a $10,000 advance grant just for applying, based on some eligibility criteria, and it was capped out based on number of employees, but you got up to $10,000. The new Consolidated Appropriations Act allows you to apply for any funds that you didn't get in the 10. So if you got a $3,000 grant, you can now reapply and get an additional $7,000. So folks that did receive a grant but didn't get the maximum 10,000, you may want to look into reapplying for that grant. I'm going to jump down a bullet there. Just note that there's been some guidance that all of those EIDL loan advances are not going to be treated as taxable income, and they are fully tax deductible. So we saw a swing, and this was going on with the PPP earlier, and we presented it in our last presentation on December 23rd. But whether these grants, PPP forgiven loans, would be tax deductible, we always knew that they would be non-taxable income, but were they deductible? Well, now we've got answers on both fronts, both the EIDL grant, the PPP, and the deductibility of those. Going to the second bullet there, this is something we probably I hadn't talked about too much, and I kind of was kicking myself because I realized we do have a number of clients that do have other Section 7A loans through the SBA. The CARES Act provided for basically payment of principal and interest for a period of 6 months, right? So that's basically a grant. The Consolidated Appropriations Act, beginning in February 2021, is going to extend that payment of penalty of principal and interest by the SBA of those loans. And if you meet any of the NAICS codes that are noted here on the slides, then you may be eligible for 8 months of principal and interest payment of your SBA Section 7 loan. And again, that payment is not going to be treated as taxable income, and any amounts incurred relative to those funds will be fully tax deductible and eligible for a step up in basis. So it's going to be treated as tax exempt income. So if you have one of those loans, you may have another 3 to 8 months of basically no payments. Not only no payments, but it will be paid by the SBA on your behalf. So you can move ahead there, Frank. And I'm gonna go pretty quickly here because I know I tend to run long, and we only have an hour, and we got to get through a lot of material here. So I'm going to try and blow through this. And if you have any questions, always feel free to reach out to Frank or myself. We're going to get these slides up and the presentation up. But in the essence of trying to get through this, we're going to go through quickly. So this is another provision that came through the Consolidated Appropriations Act. Again, probably to a small sliver, maybe nobody on this call, but I just want to make sure that folks are aware of it. If you are any of these categories listed on the top, right? Live venue operator, theatrical producer, live performing arts, museum operator, and so forth, talent representative. There are these special grants that are going to be provided through the Consolidated Appropriations Act, and it's fairly significant, right? You've got the lesser of $10 million, 45% of 2019 gross revenue, or your average monthly revenue if you weren't in operation for the full year, times 6. And as you can see, the eligible cost that the grant can be used for is fairly significant, especially when you look down at the second to last bullet there on independent contractors. The key is going to be how they define, live venue operator and the various categories here. I think obviously the ones that are obvious, right? Your museum, that's obvious. You're the Infinity Music Hall up in Hartford, that's an obvious one. But what if you're a business that potentially could fall into those categories? I think we'll probably get some additional guidance from either the IRS or through Congress as to how how broad that definition might end up being. But just be aware of it. If you think you're something if you're in a line of business where you think you're like, well, I may be eligible for this, give it a thought, because there's some obviously it's a significant grant, and there's some additional expenses that a PPP loan can't cover. So we can move on there, Frank. Okay, we talked about this last. I'm not going to go into the details here, but we talked about this on the 23rd. So there's been an extension of all these various unemployment benefit programs. And you can see that under the second bullet, the supplemental unemployment insurance benefits, that those are extended through March 21st. They've reduced the rate to $300. Frank, I know we talked earlier about this. It's, the $600 rate. And there was also, and I don't know if we want to get into this, Frank, but there was also some concerns about whether folks were, if they were on like a part-time arrangement, whether they could dip into that 600. And I know for a time period there was, but there's been some extension of these various provisions. You've got the return to work provision. We talked about this on the 23rd, but you got the return to work provision that's that states are required to provide a suitable method.
Yeah, I mean, Bill, I think we continue to talk about recommending having, the appropriate legal counsel look at some of this stuff for you. If it's part of the team. I know we had a co-developed webinar at one point with a law firm that helped us kind of manage through some of this stuff. But yeah, I think we want to continue to move. Hey, Bill, I got a quick question for you. Did you talk about an SBA Section 7 loan? Last slide. Someone's asking if that's the same as an SBA Section 7A loan. Is that the same? Is there a different concept there?
Yep, same loan.
Okay, great.
Okay, so now we get into some of the kind of the real true tax provisions, and some of these we talked about briefly, but we'll go through them again. We talked about them on the 23rd. I'm sorry, we'll go through them again, right? So the meals deduction, so that's been increased. That's been reduced over the last several years to a 50% reduction. They've increased that up to 100% for years 2021 and 2022. Obviously, this is supposed to incentivize people to go out and take clients on business meals. Now, given our situation and COVID, and I don't know whether that's going to be something that's in the near future, but certainly extends out for through 2022. So hopefully, at some point in the next few months, that's going to be a much more common occurrence. The key here is served by a restaurant. Obvious when you're going to a restaurant, but what if you're going to a ball game or you're going somewhere else where you're at a concession stand? I don't know. So hopefully some guidance will come out on that, but that's the kind of the key there. But note that the deduction has been raised to 100%.
Bill, I found it interesting. A lot of people were, saying this was a, kind of feed the fat cat provision, make the executives get able to take a benefit. I think there was a lot of thought put into this personally, and not to trying to sound like defending anything, but they need restaurants to get more business, and anything they can do to drive people into the economy to support what is a very, very impacted part of our ecosystem here. They were just trying to incentivize anybody to go out and spend some money. I thought it was pretty thoughtful to kind of give people a tax incentive reason to go out and just spend some money in restaurants,
Yeah, no, I think it was too. I don't know that there was any kind of, like, I disagree with the if people are saying that this was kind of a fat cat incentive. I get it, but I mean, you got to, our restaurants and certain other industries are really hurting, and so this was I think this was a great move by Congress. We've got our charitable deductions increases for charitable deductions for non-itemizers, 300 and 600. Everywhere you see MFJ, that's married filing jointly. There's an increase to the individual AGI threshold from 60 to 100%. So obviously we've got more kind of stimulus, not in a direct form of a payment, but they want people to be making more charitable contributions, and they're willing to give you a better tax break on those charitable contributions.
Yeah, I know, Bill. I mean, I find this again to be a very substantial, provision. I mean, people who maybe didn't get as impacted by some of this, and have the ability to donate money in any way, shape, or form. If they have an increased incentive to do that, maybe where they will double their contribution and help people that are a little less fortunate than those who didn't get impacted. I think it's a really important concept, that to continue to drive not just federal support into the ecosystem, but drive, people being able to help by just donating more money into charitable organizations that are really, in place now to really help people get through the next, 3 to 6 months. So.
Yeah, absolutely. I mean, and obviously a lot of businesses have been hurt, but, some folks have made it through very well. And
Yep,
so this
absolutely.
gives them an opportunity to kind of give back. We've got the extension of the Family First Coronavirus Response Act, those paid sick and family leave credits. Those were originally expiring on 12/31/20. Those are extended through 3/31/21. Go next slide there, Frank. Okay. I'm not going to go through all these. There are, I think I had about 77 at one point, but I might have been including some other provisions. But there's a whole bunch of tax extenders that are in the Consolidated Appropriations Act. And so, when you get this, look at the slides. Like I said, I'm not going to go through all these. You can see where all these are going in terms of, they're all trying to kind of put money back in your pocket and really kind of stimulate business. Some of them are permanent. Some of them are through December 31st, 2025, and some of them are through December 31st of 2021. And you'll see if you kind of look through these, they kind of hit all different areas, right? So you've got the 7.5, AGI threshold for unreimbursed medical expenses, right? That's really kind of pretty general. You've got your 179 deduction, but then you've got a whole bunch related to railroads and alcohol, and obviously, they're trying to stimulate the liquor business. So we can go through, probably just jump through a couple. Let me see if there's any new markets credit, WOTC credit. So these, and this is very typical of tax legislation. You've got credits that are enacted, and then they have sunset dates, and then they'll get extended sometimes for a period of 1 year, 2 years, permanent. These particular credits, the WOTC credit is extended through 2025. Let me see if there's anything else here that's of note.
Hey, Bill, my head's spinning. Anyone who knows me here knows I'm an audit guy, right? Insurance, advisory. I keep saying, this is great. I think people need to understand the complexity and the depth of what was released, right? And then what we're trying to show people here. This 90% of this may not apply to most people, but it's really important that you work with your tax advisor on trying to make sure that you're not giving away something or not taking advantage of some of the credits, right? And there's a lot here to kind of work through, and
Yep.
most people aren't going to work through the legislation like partners and tax firms need to. So.
Absolutely, and these are the tax extenders that came out through the Consolidated Appropriations Act. There's a lot of provisions that came out through that CARES Act. Some of those have been extended, but keep that in mind too. That's still going to impact your 2020 return. So you should be talking to your tax advisor and saying, okay, we've had previous webinars on some of those key provisions. Those were back in March, right? So these are really just kind of new extenders that are out there through the most recent legislation. So yeah, keep it in mind. Again, I just wanted to provide a kind of a laundry list of things, as so that you can kind of look through it quickly and say, hey, well, you know what, we're in the energy business. Let me reach out to whomever my tax preparer is and say, hey, I saw that there was an extender on this credit. Am I eligible? Okay, and we've got a bunch of extenders for a year. Some of these are individual energy efficient homes credit. We've got some excise tax credits. Again, 90% of this probably won't apply. Okay, all right. Here's kind of the teeth of where I really want to spend most of the time today. And we talked about it on the 23rd. I did it in a one-page slide. for today. I really tried to break this down because I really think it's important for everyone on this call to think about this employee retention credit and how they can use it to create cash for their business if they meet the eligibility criteria. And we're going to go through it kind of in detail here. So really kind of high level, right? This was enacted in the CARES Act back in March. And even at the time, it was you look at it and you say, well, this is fantastic. This has got a potential to really get cash back in businesses' pockets, stimulate the economy, and really could provide a significant savings. Well, there was really the biggest issue for this credit, although this credit was not limited to small businesses, was that under the CARES Act, if you received a PPP loan, even for as little as $1, you could not take advantage of the employee retention credit. And so it really kind of put this whole program to kind of the back burner in terms of who could use it. Well, the Appropriations Act comes in and basically says, if you received a PPP loan, you can take an employee retention credit. However, you just can't double dip on the expenses. So let's just kind of quickly go through. So it was originally intended to be an offset to the employer share of the Social Security tax. To the extent that your credit was greater than that amount, it became a refundable tax credit. Well, as the IRS started issuing more and more guidance on this, and as they started to see that there was a need for this, although anyone who had a PPP loan couldn't take advantage of the credit, they started allowing taxpayers and keep this concept in mind. The PPP program is run through the Small Business Administration. The Employee Retention Credit, and I really should have ERC there, is a tax credit run by the Internal Revenue Service. So we're going to have a couple different definitions here that we need to be aware of in terms of when we compare to the PPP. But the IRS started allowing folks to basically not have to wait until they filed their 941 to claim this credit. They basically started allowing companies to just offset your payroll taxes, and not only offset your Social Security, the employer portion of your Social Security tax, which is what the credit was actually designed for. They allowed you to offset your withholdings, right? And that's and in the end, it didn't matter because it was a refundable credit anyway. So pay me now or pay me later, but that's pretty significant if you can capture that in real time versus having to wait till the end of the quarter, file your 941. The form that the IRS issued was this Form 7200 in order to get the refund of the credit. But if you could advance that and do it through offsetting payroll deposits, then that's real cash in your pocket sooner rather than later. Yep.
Hey, Bill. I mean, one of the questions that came up, and I know we wanted to make note of this, is this is available for not-for-profits, right? So
yes,
it's a very important concept. And I know we have a lot of not-for-profit people that participate in our webinars, and we have Amber Tucker in our firm who's really driving that practice with Brian Kelleher. And, listen, this is a huge opportunity for all companies. And that's why not-for-profits who maybe think tax, hey, it doesn't apply to me, these credits definitely are something that you're going to want to pay attention to. So,
yep. Okay, so I think I'm going to go through a detailed calculation, but we can go to the next slide, Frank.
Yeah, and
go ahead.
Just to give you a little bit of, everybody who sees ECRs, it's ERC. Yeah. Bill didn't have my expertise to overview the presentation because I've been on calls all day. So, we got to deal with his limitations on being able to make acronyms. In the tax department, they don't have acronyms. In the audit department, we do acronyms all the time. So that's all ERC. We're going to call it ERC, Bill, but you don't want to.
Yeah, we'll call it ERC. Yeah. That's probably going to run the entire presentation, but we'll get that fixed
right
when we get it online. Okay, so who's eligible? So as you just mentioned, good point, Frank. You got for-profit and nonprofits under the letter of the law, carrying on a trade or business. Right now, what they said is well, if you're a nonprofit, you're deemed typically carrying on a trade or business means you're carrying on a trade or business for profit, right? That's the way the Internal Revenue Code, Internal Revenue Service defines a trade or business, right? But they made an exception for nonprofits, basically saying we're going to deem that you're carrying on a trade or business. Comment here, no employee maximum. That's going to be, this employee issue is going to be critical as we go through this, but understand that in order to take advantage of the credit in some fashion, this was not limited to small businesses. We're going to see how small business, large business actually becomes a big factor in this, in the calculation, but in either case, you're eligible. Okay, so now you've got, okay, so I've got my for-profit business, I'm carrying on a trade or business, I'm nonprofit, I'm deemed to be carrying on a trade or business, I've got however many employees. I've got to meet 2 criteria. And this goes back to 2020. Now, recall, originally, if you had a PPP loan, you couldn't take the ERC. But now, as of December 27th, when President Trump signed the law, well, now you can go back. And so we're still awaiting guidance on how that's going to happen, going back and trying to kind of commingle these 2 programs and manage these 2 programs. And it's important for you to get to your tax and accounting firm sooner rather than later, so that you can get this ironed out. So you want to make sure you can double dip, not double dip, but you can get both benefits if you receive the PPP loan. Okay, so there's 2 criteria, and this goes back to 2020. We're going to talk about the provisions that are 2021 only coming up in a few slides, but there had to be a full or partial suspension of your operations in any calendar quarter in 2020 due to some sort of government order, and I'll say federal, state, and local, but any kind of government order. And this is critical: limiting commerce, travel, or group meetings due to COVID-19. That's that's prong number 1, right? And so we get this, as I've talked to some clients about this, it gets a little bit tricky unless if you're in a certain industry, it's pretty black or white, right? I'm in the restaurant industry. Governor Lamont said I can only have 25% capacity. I mean, that's pretty easy. But what about the business that's not in the restaurant industry, but that and was deemed to be an essential business, like an accounting firm, but may have had some other restrictions in place? You really kind of need to go back and pick through, if you're in Connecticut, pick through Governor Lamont's orders, pick through the CDC, and we've been doing that, trying to apply them to certain clients and their fact patterns. Picking through CDC orders or OSHA orders and saying, okay, did that apply to me? And if it did, now you've got an eligible period that you may be eligible for this credit. Okay. Or this is 2020. There was this reduction in gross receipts, right? So it was a 50% reduction, pretty significant, right? So you had to look at a quarter in 2020. Let's take quarter 2, right? And you had to go back to quarter 2 in 2019 and say, okay, well, my receipts were 100 in quarter 2. 100,000 in quarter 2 in 2019. If I had 51,000 in quarter 2 of 2020, I don't meet that reduction test. But if I had 49,000, now I've got an eligible quarter.
So okay. Bill, can I ask a question here?
Yep.
So you're saying this is the 2020 review of 2020. So now that more people are eligible for the ERC, are we reviewing on this slide? Because I know there's a lot of people that are going to be a little confused by this. Are we reviewing on this slide the impact that can be applied now for people that are now eligible, but they can go back and apply it to 2020? This is what they're going to have to meet in 2020, even if you got a CARES loan, even if you got a PPP loan at this point?
That's correct. And the ERC, the Employee Retention Credit, right? It now has 2 different sets of laws. It's got 2020 laws, which we're talking about now, which if you received a PPP loan, this thing was not even a consideration.
Right, you never even looked at this. If you got a PPP loan, you didn't even look at it.
Never even looked at it.
So now you got to go back. You got to go back and look at it.
Yeah, now the Appropriations Act says, well, you can still take the Employee Retention Credit, and that's brand new law as of the 27th.
Right, and now I just want to be clear. Right, so now I'm a business. I got a PPP loan. It's December. When this thing gets approved, I now have the ability to go back into 2020 and look to see if I can take advantage of the ERC, but I need to apply it using this slide.
You need to apply. These are the laws that you would apply for 2020.
All right,
Correct.
just so
Correct. Now-
everyone's understanding, because it's going to be different now. If I move into 21,
Yep, we're going to talk
Right.
about. We're going to
we're
talk.
going to talk about something that's a little different. All right,
Yep,
great.
yep. And we talked about this a little bit on the 23rd, but I just want to re-emphasize this. And like I said, we blew through it in one slide, and I want to really dig through this. Okay, but you got to go back and apply the 2020 laws. You know, obviously the issue that we've just been talking about is you never knew the, you know, if you had known you were eligible for it, you would have looked at quarter two and you would have said, hey, we had a decline in revenues. That was an eligible quarter. Let's get these employee retention credits. Let's file for them. You know, I got a PPP loan, but I had this type of spend that was over my PPP loan, and et cetera. Or I hadn't gotten my loan till May, so I had some eligible spend in Q2, and you would have started deducting your deposits right then. Well, now we're past that, right? I mean, you're still going to be, you probably haven't filed your Q4 941, but Q2 and Q3, those are kind of long gone.
So Bill, if you so you're going in, and I'm a non-tax guy, so I'm going to ask the questions that everyone can't ask, right? So, okay, I go back. I'm a PPP recipient. I didn't think I could do this. I take your advice. I take this slide. I go back, and I'm like, oh my God, I qualified now in Q2 and Q3 and Q4. Do I lose Q2 and Q3 because that process is gone, or do I apply it all in Q4? How do I do it?
No, when well, that's a good question. We're awaiting guidance to see, do you go back and amend Q2, Q3, or can I claim the credits that I was eligible for in Q2 and just put them on and just do it, you know, reduce my my Q1 deposits, or file my 941, take the credit there, and then file the form 7200 and get the refund on that. I don't
think I knew that
answer.
That the answer wasn't clear, but I want people to understand we're still fighting through some of this stuff. But the critical component right now is you got to go back. You got to go back. You got to look at it.
Yep.
You got to make sure you're not giving away a credit, and then you got to work on how you're going to apply that and get your money back. So, we moving on here, Bill, or what do you want to do?
And for folks out there that have, you know, if you're a small business in Connecticut only, right? Obviously, you're going to be looking at Governor Lamont's orders. But if you've got a multi-state operations, right, and certain areas of the country had, you know, harsher restrictions, some had none. But you know, California had a lot of, like, you know, shelter-in-place orders that were sent out. New York had some of the same. So you're going to want to look through your various states of operation. Okay. Okay, so we went through the government order. Okay, so I just put some examples down here. You know, I'm not going to go through all these, but I want to kind of focus on the second sub bullet. What is a government order? There has to be a nexus between the order and the impact on the employer, right, on the business. So if you had an order that Governor Lamont issued some sort of a shutdown, or you're a non-essential business and you're, you know, required to restrict your operations, or not have people in the office. If that didn't impact your business, and they haven't really demonstrated how they would, or IRS really hasn't spoken on how they're going to demonstrate that. But if it didn't impact your business, you're not eligible for the credit, even though an order was issued. So I got a couple. So a couple bullets in red here. Voluntary shutdown. So that question has come up, and I know a lot of businesses have done it. To protect your employees, you said, okay, Governor Lamont said, you know, essential businesses can stay open, and the laundry list of essential businesses is much more significant, much bigger than you would have thought it was. Certainly was a lot bigger than I thought it was. But you say, you know what, based on where we are, the situation we're in, I'm gonna let people work from home. Well, that's not a government order requiring a full or partial suspension. So
Bill, let me give you an example of something like maybe some of our clients on the technology side. So we have a client that provides software and services into big events. The big events, they weren't happening, right? You couldn't have a big event. You couldn't have anything that was over 5 people or whatever, right? You couldn't have 100, 200 people. If that company didn't get a direct impact from a government order, because they're a technology company, they weren't right, but their industry was shut down. That's that's not someone who would qualify for an ERC, correct?
Yeah, well, no, Frank, but if they had that kind of going on, they may meet the gross receipts test.
That's right. So that's what thank you. You went right down the road I was talking about. So now they didn't have a government order, but they go back and they're like, they were decimated in Q2, right?
Right.
Decimated in
Yep.
Q2 of 2020, right? They were down by 50%. They can go and apply. Boom.
Yep.
Okay, great.
Okay, so a couple of these questions are, if government order is in place, okay, so this is a straddle question, right? I've got a government, and this was probably pretty likely, right, early on in the pandemic, right? A government order is in place from March 26th to and these are all calendar quarters, by the way. If you're a fiscal taxpayer, you've got a different year end. You're not looking at your quarter, you're looking at calendar quarters. So a government order is in place. For these dates, right? That straddles Q1 and Q2. Can I claim the ERC Q1 and Q2 on all wages in the quarters? No, only wages paid during the period of suspension may be included, right? And you're going to have.
This is a great question, Bill. This is
Yeah.
a great question. We have a question coming up. So salons, let's talk about it. Salons, hair and nail would qualify for the ERC as they were shut down by Lamont for a period of time. Yes, but they can only do it during the period they were shut down, right? They can only calculate it during that period.
Correct. Unless now, so here's the rub, right? Yes, you're better off meeting the gross receipts test if you can, right? I mean, it's 50% reduction is pretty significant, but if you meet the gross receipts portion of this test, the whole quarter is in play.
Yep.
If it's a shutdown or part suspension, only the period of suspension is in play.
That's
in terms
right.
of wages you paid during that period.
Yeah, it's a great example, Bill, and I love going through the examples like this because I think it puts it in perspective, right? So I think someone who owns a small business like a salon or something that was totally shut down for a restaurant, they're going to have a lot of ability to go through calculations to figure out, okay, I had to shut down for this period of time, but my revenue decline was, a lot bigger and a lot deeper over multiple quarters. That's where you're going to maximize your credit. That's how you got to go through the process of making sure you're not limiting yourself and not taking advantage of the either or concept, right?
Yep. Absolutely. Okay. So this was interesting because it was counterintuitive to what I thought it was going to be. If a government order suspends business in New York, can I claim the ERC for employees working in Connecticut? You look through the IRS frequently asked questions, and it's a pretty lengthy. They actually did a pretty good job on this. There's got to be 100 questions that they answer. And it's got and like sub questions. I mean, it's pretty exhaustive. Now they're gonna have to rewrite it because of what we're gonna get into later. But the IRS deems you an eligible employer nationwide. Now I think you still have to go back to the test of, well, if I had a shutdown in New York and I've got employees in Connecticut, for the employees I paid in Connecticut, can I take credits on that when those operations were not impacted? I think the answer is probably not, but you're still an eligible employer nationwide. At least that's what the IRS says. But consider that if you have multi-state operations, like again, talk to your advisor and say, hey, listen, we had a shutdown in New York, but how direct of a nexus can I draw that to my Connecticut business? Because if I can, maybe I can get credits on my Connecticut employees.
Yeah, Bill, time check. We got 3:43. Right.
Okay, sorry. Okay, telework. This is it's important, right? If you're able to maintain operations through telework, you don't get the credit, even though there's an order. So, all right, next slide, Frank.
But if you had the decline in revenue, you do.
The decline in revenue, you do. Yep. So here's our gross receipts test. Now, again, this is the Internal Revenue Code. So we're looking at Internal Revenue Code Section 448C. So there's the definition of your gross receipts. The second bullet, sale of assets. If you sold a bunch of assets in 19 and had a decent gain, you might be eligible just because that gain was that sale of assets was in a prior quarter. Even if your standard revenues only dropped by, your normal operating revenues only dropped by 25%. Maybe you had a bigger drop because of that sale of assets. They haven't really defined it for nonprofits, assuming it would be some sort of grant revenue concept.
Yeah, I would think grant revenue, contribution revenue, whatever they would define as their growth on the revenue line item, right?
Yep. So second bullet there, this is pretty important. let's say you meet the test, you meet the revenue test for Q2, and that's probably when folks, are most likely to meet it because it was such a new concept, and COVID was brand new, and I think there was, a lot of uncertainty, especially at that time. You maintain that eligibility until your gross receipts go to 80% or more, and then at the end of the next quarter. So let's say you had a 55% reduction in Q2 2020. Then you look at Q3 versus Q3 in 2019, and you only had a 25% reduction. You're actually still eligible.
No.
You're actually still eligible, right? And then you go to Q4, and you had a 15% reduction. You're eligible through the end of Q4 because you now, and then when you go to Q1, you wouldn't be eligible. So
yeah,
once you maintain your eligibility, you kind of get it. You kind of get it for 2 quarters.
Yeah, this is important,
Yep.
Bill, because now that tells me in my world, right? You got a trigger point and then another trigger point, right? So the 50% your trigger, and then 20% your next trigger. It seems like 80%. So the inverse 20%.
Yep.
Really important for people to understand. Hey, Bill, can you do it to only a single line of business? I don't think you could, right?
No. Now I'm going to get into that. You got to aggregate. So you've got to aggregate your businesses for the gross receipts test. Even if you're in like a consolidated group, you've got to aggregate all that.
Okay.
Yeah, that question came up, and it was a really good one. I talked to a client last week, and hadn't really had a lot of certainty. But yeah, that's how they're going to handle that.
I moved you along, Bill.
Okay. Yeah. Okay. Credit calculation. All right. So haven't even gotten to this point yet. The kind of just high level. It's 50% of your qualified wages up to a maximum of $10,000 of wages, right? So you're getting a $5,000 credit per qualified employee to the extent that you pay them $10,000. And again, for 2020, this is for the full year. So if you're looking at starting on March, it started on March 12th. It's $10,000 paid through the end of December 31st, right? So if you paid that person and you were eligible all 4 quarters, but you paid them $100,000 during that period, you're only getting it on the first $10,000 of eligible wages. So you're looking at a $5,000 credit per employee. Okay, if you're a small employer, so this is where that small employer, large employer definition became important. It's available to anybody, but a small employer, someone with less than 100 full-time employees, and they look at that. During our PPP, it was a 40-hour work week. Now under the Internal Revenue Code, it's a 30-hour work week. You're getting
full-time employees are defined at 30 hours a week for this credit.
Yep.
Let's just be clear, right?
Yep.
All right.
30 hours. Okay. So you're basically getting a 50% of 10. So call it a $5,000 credit, assuming you're paying these people more than $10,000 during the eligible time frame. And that credit is the key here, and I should have put it in red. Amounts paid to qualify to any employees. So any employee if you're eligible, then you have 97 employees. You're getting that credit you're getting a $5,000 credit on all 97 employees, right? If you're a large employer, so now we've got 100 employees or greater, and I'm not exactly sure why they drew this sharp of a distinction. It's the same credit calculation, but you're only getting that on employees that do not work, right? I guess I did bold it here, right? So you have to go through an analysis and say, okay, I had 150 employees. I paid everybody, and 125 people worked, and 25 people really didn't work, or they had a reduction, or we reduced everybody's hours by 50%, but we paid them 100%. Well, you can take the credit on the amount of hours that you're not paying them.
So really important. If you're now 100 full-time employees measured at 30 hours a week, if you're under that number, you get the credit on every employee in your company once you qualify.
Once you qualify. Yep.
Gotcha.
Yeah, and again, if you qualify, again, based on the criteria. Now, if you're getting the criteria based on government orders, again, your window is shorter. If you're getting the criteria on gross receipts, you're really getting a 2-quarter window, because it doesn't end until the last day of the quarter in which your gross receipts are over 80%. So you really get the 2 quarters. Okay. A couple, let me see. Yeah, cool. WOTC credits. What's the, okay, PEO. You can go to the next slide, Frank. Okay, we talked about that. It's not taxable income. There are specific provisions here. Now we talked about it with the new PPP, and if you take wages for this credit, just know that you may have a Section 199A reduction or an R&D credit impact. So just be aware of that. We talked about the aggregation rules. That was a question you just brought up, Frank. Okay, now we get to 2021. So this program was set to expire on December 31st of 2020. Okay, so now we get the Consolidated Appropriations Act, and there's a bunch of changes. Everything I've listed here is retroactive, is going back to that period which is discussed. Everything that I'm saying is new, is kind of like new law, new calculations, and so forth. Okay, so we got the PPP loan. Okay, so we're expecting the IRS and the SBA to come forward with some regulations, because if you received a PPP loan, a lot of things happen, right? A lot of people were, you chose you had the 8 weeks, you had the 24 weeks. You may have, you got a loan for $100,000, but you submitted $300,000 of payroll expenses. Well, there's a lot of fungibility of those expenses. If you're eligible for this credit, what's your ability to move around those expenses, right? So if you received your PPP loan on May 15th, let's call it dead set in the middle of Q2, and you became eligible in Q2, can you use the back end of your 24-week window of the PPP? I don't know. I have a feeling that's not going to be the answer, but we'll have to see what they come out with. And can you go back and amend a PPP application? Let's say you only claimed payroll expenses because that made sense when you submitted your PPP application. Can you go back and amend that and say, well, wait a minute, I had 40% of rent and utilities and all the other good stuff. Waiting to get some more guidance on that. Retroactive healthcare costs, right? So it was always qualified wages and healthcare costs allocable to an employee. And again, you're looking at a $10,000 max here, so you probably captured it in wages. But where this becomes critical is, if you had an employee on furlough but you're still paying payroll cost or healthcare costs, you can include those. Okay, then now we're extending the credit through. Now we're bringing the credit for Q1 and Q2 of 2021, and we've got all new rules that are going to apply.
So Gail, I'm going to reiterate this. Old rules don't go away. You don't apply the new rules backwards. Old rules are for 2020. You now have the ability to go back, if you're a PPP recipient, to go back and apply those rules under the 2020 rule structure. And I assume, Bill, and this is a question, and I now apply these new rules into 21.
That's absolutely correct. Yep.
All right, great.
Okay. So now we've got an increase of the credit rate to 70%. So remember, we were 50% of the first $10,000, right? For qualified wages in Q1, and this runs through June 30th, so 2 quarters. And now for 2021, that cap is $10,000 per quarter for each quarter, right? So not only am I increasing the rate from 50 to 70%, but it's not the $10,000. It's not total of $10,000. It's $10,000 per quarter. So if I pay, Bob $10,000 in Q1 and I'm eligible in $10,000 in Q2, I just picked up a $14,000 credit versus the $5,000 credit I would have gotten under the old laws if they just extended the program for through June 30th, but hadn't put in these new provisions. You would have been your credit obviously is significantly greater. Increasing the threshold. This is pretty important, right? So we had that small business, large employer, small employer, 100 employees. Well, they've upped that to 500. So if you had 450 employees and said, Bill, that's great, but you know what? We kept people employed, we furloughed people, so they were, they essentially were getting paid, or reduced hours. So they were getting paid to work. We really weren't paying people not to work, and we had 450 employees. 2020, you're out of luck. 2021, you're in luck, right? Because now you're a small employer, and you can take the credit for any employee, not just employees that are not working. They reduced the gross receipts test from 50% to 80%. And again, and they allowed you to go back to 2019, which is, logical, right? Because you probably had a reduction in receipts in 2020. That's why you're even eligible. You're in this boat. So you're allowed to look back as your measurement year back to 2019.
So that's a 20% decline in business now qualifies you.
Yep. Now
Yep.
qualifies you. Safe harbor allowed. Okay. So if you want, so let's say you're in Q1 and you're saying, well, we're starting to come out of this. We're having a pretty good, we're off to a good Q1. You're looking at this in February. You're projecting a decent quarter. Well, we're going to be at, 100% of our Q1 2019 receipts. You can go back to they're going to allow you to go back to Q4 and say, okay, let me compare Q4 2020 to Q4 2019. Because maybe you met the test back in Q4. I don't know how much that's going to come into play, but understand that the safe harbor law is out there. We can go to the next slide, Frank. Oh, is that it? Okay. All right. Let's go back up for 1 second. So anyway, you can see how this program is significantly enhanced, not only through the ability to go back to 2020, but through what's going on with the 2021 provisions. And so I really, really implore anyone on the call here to just, a nonprofit or for profit, right?
So Bill, self-employed applicants, can they take ERC? Do we know?
I have to take a look at that.
Me too. I couldn't answer the question. Yep.
Yeah.
So we'll have to get back to people on that one.
Yeah.
Do you average the hours? If someone's working 15 hours one week, 40 hours another week, do we know if it's an average calc?
It's an average calc. Yep.
It's an average calc. Okay.
Yep. And there's special rule. If you weren't in business for all of 2019, but you were in business prior to February 15th, there's rules on how you come up with your average. And again, reach out to your provider, and they can kind of walk you through some of those specific rules.
Okay, we got a couple minutes left, Bill. Do
Yep.
we have a lot of slides left?
No, let's quickly go through this, and I'm gonna go through the PPP quickly.
So you want to keep going?
Yeah, let's keep going. Yeah, because I want to talk about this. So I've got a lot of questions on the payroll tax deferral. So there's two payroll tax deferrals. There's the original payroll tax deferral, which was a deferral by the employer of the employer portion of payroll taxes, right? And so, you had all the nonsense with, well, if you took a PPP loan, could you defer taxes? That was all resolved. So, so you've now deferred your employer portion of your payroll taxes. Maybe you deferred that for the entirety of 2020, right? That remains unchanged. 50% of that is due on on December 31st, 2021, and the other 50% is due December 31st, 2022. You can pay it earlier. Okay, so and that remains unchanged. If you're an accrual basis taxpayer, you can't deduct, even though you accrue those payroll taxes, you cannot deduct them until you pay them. And the IRS is going to give you until September 15th of this year to basically pay those taxes so that you can deduct them on your 2020 return. So talk to your tax preparer and say, hey, listen, I want to get this deduction, right? I want to get this deduction in 2020. So I'm gonna fast forward my repayment of these payroll tax deferrals. Okay, the employee payroll tax deferral. So I think that's what kind of caught a lot of people's headlines, because that was extended, right? So that came in through the executive order by President Trump. I can't recall exactly when it was. I want to say it was around August. He came out and basically said, well, we're going to allow employees to defer their portion of their payroll taxes. Well, I got to be honest with you. I don't know anyone that did that. You had to pay it back by the 30th of April of this year. It didn't seem to make sense. It put businesses in a real tough spot, because if an employee left, the business was kind of on the hook. So I don't know a lot of businesses that did it, but if you did have an employee portion deferral, they extend the payback period to the 21st. Okay. PPP, we went through a lot of this on the 23rd. This is the key tax provision. The IRS just recently, I think it was a couple days ago, basically came out with their notice saying, hey, all of our prior notices are obsolete. This is, if you haven't heard it before, this is the big, this was the big debate, not really a debate, but the big question mark was Congress going to do something about these IRS notices? Because if you got a PPP loan, it wasn't taxable income. And then the IRS came in and said, well, we're not going to allow you the deduction. Well, that's, in their view, that seemed to be the right answer, but certainly killed the intent of the PPP program, where, especially for a struggling business, you're taking out the loan so you can keep people employed, and now you're getting taxed on that money that you need to keep people employed. So anyway, the Consolidated Appropriations Act comes out with those statements. It's not taxable. The deduction is permitted. No tax attribute. Credits should be unimpacted by PPP loan forgiveness, and you get a step up in basis, which is critical to all our pass-through entities. Okay, so the Appropriations Act for the PPP, everybody's like kind of hot and set on round 2, but just know that they are reopening round 1. I think they allocated $35 billion to that. So if you didn't apply for a PPP loan, gave it back, what have you, you can still get a PPP loan, and it's under the old rules. So it's not the new rules we're going to talk about. Don't apply. So it's the 500 employees, right? You still have to. It's still the kind of the loan necessity question is still in play. You can get up to a $10 million cap. Same rules apply as the old program.
Hey, Bill.
Yeah, go ahead.
Yeah, someone's asking, hey, I got a loan under the original one. I paid it back. It got forgiven. Can I go back and now apply again under the PPP2 loan?
Yes.
The bottom line is you can, but you have to be able to meet the eligibility criteria.
Yeah, you have to meet the eligibility criteria.
Yep.
I thought the question you were going to ask, Frank, was I received a PPP loan. It's been received. It's been applied. Forgiveness has been applied for, and I've been forgiven. But FML, you guys mentioned in bullet number 2 there that if I was a previous borrower, I can go back and increase my round 1. Well, you can if you've been fully forgiven. And I have to check on this. I feel like I read it somewhere. I wasn't able to get it into the slides, and I can't recall what the statement was in the act. But I know you have until and I think I have it here somewhere in the slides. I think you've got until March 31st to file amended PPP round 1 loans. I can't recall how the
So I mean, what you're saying, Bill, is because of all the rule changes, if I went in and applied and I got $100,000 on PPP.
Yep.
But now that I go back and look at it with my advisor, I could have gotten $200,000. I just messed it up. I just didn't understand the rules. You can go back and get another $100,000.
That's a great statement, Frank. So you can go back and get an additional amount if the rules changed from the date of your application. So the perfect example is under the original rules, if you were a partnership, it was very unclear whether you could get a PPP loan and include in payroll compensation paid to partners, right? Then the SBA clearly came out and said you can, and here's how you can compute it. Well, a lot of partnerships filed their loan application, and didn't include partner compensation, so they really they didn't maximize their loan. So they can go back because a subsequent rule clarified that issue. If you just, screwed up the math, didn't know, whatever, it was your own mistake. You can't go back. You can't go back and amend your return.
That's clear. That's clear, Bill.
That's the way I understood it.
All right. Hey, Bill, we're past the 4 o'clock, so we're losing some people.
Yep.
People are here. We have a lot of people. I think we still have like 80 people on the call. So we're going to keep going. Grab another drink. We're going to keep going through the slides. And if you got to drop off, we'll get the slides out to everybody. All right.
Yep. Repeal the EIDL grant reduction on loan forgiveness. This was a common fact pattern. A lot of folks got an EIDL grant, then filed their PPP loan forgiveness. Let's say you got a $10,000 EIDL grant. Filed your PPP, let's say you had a PPP loan application of $100,000. You probably only filed for forgiveness for $90,000 because you couldn't take the grant and the PPP loan forgiveness. That's been repealed. So you should go back and amend your PPP loan forgiveness application. Now it's only, it's $10,000. So I guess it's in the broad spectrum of how big your loan was, but you can go back and get that $10,000, get that off your PPP for your PPP loan forgiveness that you used it by. All right, I'm going to quickly go through this because we talked about it earlier on the 23rd. So your loan calculation is same calc, right? 2.5 times. If you're in one of these NAICS food service, you get 3.5 times your monthly payroll. Same categories for payroll, except for the bottom one, group benefits for group life, disability, visions, or dental. That's retroactive. Now, I don't know how big that number is for folks, but if you got a loan amount of something that didn't include those in your payroll costs, you can go back and amend your application to get that as an extra loan. The max loan. So under the old program, recall we're now talking about round 2. Under the old round 1, our max was 10 million. The new max is 2 million. 4 million in the aggregate if you have a bunch of affiliated businesses, right? So like I have a client that received loans, multiple different businesses. Even under the aggregation rules and the affiliation rules, they still had to be under 500 employees for the entire group, but on a entity by entity basis, they were able to get more than that amount. Well, now they're capping that at 4 million. Okay, eligible entities. This is pretty critical because there was guidance that came out. What's today? Friday, Wednesday. I think it was Wednesday. The SBA has Wednesday. SBA has doubled down on this loan necessity issue, right? And they basically have said, hey, if you're trying to get a round 2 loan, just remember that you still have to certify that it's necessary to maintain operations due to the uncertainty of the economic environment, right? Well, I think, and we talked about this, if you go back to March and April of 2020, I think everybody could say there was uncertainty to a degree. And as we went through this, the FAQ question 31 and the loan necessity questionnaire that came out in November, I feel comfortable going back to that date because I'm looking at my snapshot in time back to that date and say, hey, there was uncertainty. Now we're in round 2. I don't know. I mean, it's going to be based on your fact pattern, but I think you need to kind of relook at it and say,
this is important, Bill. I mean, there's a lot of people lost a lot of sleep when the eligibility, they came out with question 31 and they did all those things to question people in hindsight to say, you really need the loan? Did you really need the loan? Because some people got the loan and their businesses weren't impacted nearly as much. I think this is important, right? I think it's one of those, hey, you better just sit back and not just assume that because you're basically show qualification or criteria, you're eligible. You just got to go back and make sure that you're documenting what you need to on the eligibility side.
Yep. So it's kind of a whole new, analysis that you need to go through for your business, as of now. And so that's probably going to knock a lot of folks that got the round 1, may have a tough time certifying that because they've gotten through it, right? They've gotten through it and they've, and through all the good work that they've done, they've gotten through it. And now they're sitting here now and it's like, okay, well, I don't know if I had that same uncertainty. I figured it out, right? I figured out how to maintain and operate my business. Now, maybe you did that because you had the PPP, so you're going to need it for round 2. But anyway, something that folks need to consider. In operation as of February 15th. Okay, now change 300 or fewer employees, right? Before we were talking about, and these are all full-time equivalents. I probably should have put that in the slide. Used to be 500. Now we're down to 300. So we're limiting the size of the number of applicants here. Okay, this is I thought I changed this. I just want to be clear on this. This third bullet, fourth bullet. Have used or will use the full amount of their PPP round 1 loan prior to disbursement. I want to make sure, and that will be in this corrected slide. I thought I had corrected that, but prior to disbursement. So you can apply, and I don't even know if this fact pattern is relevant for anybody, but you can apply and have fully exhausted your PPP loan. You just have to have it fully exhausted by the time you get the disbursement. Now, I don't know how folks are supposed to actually.
Yeah, real quick, Bill, 501c6s for our not-for-profit friends out there, definitely now eligible under the second round where they weren't under the first round of PPP, but you still need to qualify, still need to be eligible based on the fact pattern. So
that's exactly. Okay, so now we've got another gross receipt, gross revenue decline test, right? So we had for the employee retention credit, we had the 50% for 2020. We have the 20% for 2021. We got 25% test for the new PPP round 2 loan. And so you're looking at any quarter in 2020 as compared to that same quarter in 2019. Right. So if you had a decline in Q3 of 2020 and you compare that to Q3 of 2019, you're eligible under the gross receipts test. This next bullet, which I have in caps here, I thought was pretty important. I believe this was in the new guidance, and it was a question that had come up from a couple folks. But again, keep in mind SBA versus Internal Revenue Code. For SBA, gross receipts include revenues from normal operations, right, before subtracting expenses. So normal operations versus the 448C test that we talked about under the Internal Revenue Code. And they specifically say that if you have a loan forgiven, that is not a revenue from normal operations. So if you had your loan forgiven in Q4, don't include that in your revenue when you try to compare Q4 to Q4 of 2019.
Yeah, that shouldn't be a big issue because it should never go in gross receipts. Should always go in other income on the forgiveness side. But yeah, it's good that they clarified it.
Yeah, I agree. I mean, Frank, you and I talked about that, but it was good that they clarified it because you just never know. Okay, special rule. Okay, so you can use a calendar year election. I don't know if that makes sense. It's in there because if you had a reduction, I guess that would require a reduction overall by 25% in any single quarter. But you can compare 19 to 20 overall, and if you have a 25% reduction, you meet the test. I'm not going to go through this, but a bunch of special rules. If you were in business, if you got into business in 2019, you can compare certain quarters versus other quarters. Take a look at the slide.
Yeah,
okay.
Hey, Bill,
yeah,
the concept of FTE has not changed from round 1 to round 2, correct?
Correct.
Okay.
So these are just kind of some random points here, but just new points that are kind of new points either through the Appropriations Act or through the interim rules. So here's where I corrected it: prior to disbursement, but not prior to application. This was similar, right? So if you're a seasonal business, you can use that it's actually 12-week period between the February 15th and June 30th to determine your average monthly payroll. New borrowers, again, you have to be in business before February 15th, but you can use your average monthly payroll cost up to the date that you apply for forgiveness, right? So you can, if you started your business in January, right, you're just going to look at the months preceding your application date, and then get your average monthly payroll from there.
Hey, Bill, interesting question. For those of us who work with healthcare institutions, they received a bunch of money from HHS. They had payments that were made. Do you remember in the guidance that came out, Bill, if those amounts are considered revenue in 2020? Because they got additional amounts pushed out to those healthcare organizations as part of the process that happened in 2020.
Yeah. I don't think they are, Frank, because I think it reverted, and I think they actually provided an example but I don't have it in my slide here. But just going by the kind of the basic premise of normal operations,
I would agree with you.
I think there's an exclusion there, but I'd have to go find it, right?
Yeah. So someone asked a question. I think they should just reach out to their advisor. I'm sure it's clarified in the Q&A and that sort of thing. But those are the sorts of questions that people need to work with their tax and accounting advisor on.
Yep. When the CAA came out, it looked like folks that were in bankruptcy could apply for the PPP as long as there was approval by the SBA. Well, the SBA has spoken on that. They've basically said if you're in bankruptcy, you're not eligible. So I'm not really sure how that happened, but it did.
Hey, Bill, the streamlined forgiveness one, Bill, do we know, does this apply back to the old loans or is it just for the new loans?
No, it's supposed to apply back to the old loans. Now you've got your 3508S for your $50,000 loans and less, but it's supposed to apply back to the old loan. So if you have a loan of 130,000, and you haven't applied yet, my understanding is that the SBA is going to issue some new applications to basically allow you to do that one pager that we talked about on the 23rd, which is basically just a statement that you use the funds in the appropriate way, and you're not.
Yep. Still got to certify that you're doing it right. You just don't
Yep.
have to fill out all the info. Yep.
Yep. Covered period, any period between 8 and 24 months. You know, 8 and 24 weeks. Sorry. Of note, can you tell I was doing this late last night? Compensation must be prorated. That's a pretty critical point. So that whole concept, it was a little bit, I don't know, it was a little bit blurry during round one. You know, the interim rules and the instructions said you could use a period of somewhere between 8 and 24 months, but the law, or 8 and 24 weeks, but the law said it was one or the other. Well, now they're specifically saying you can use a covered period of 12 weeks. You just need to prorate your compensation. So you can't, if you do, you can't pay Bob $46,154 during a 12-week period. You're going to prorate all that down.
Hey, Bill, just really to clarify, the first PPP round, it's over, right? You can't apply for it anymore at this point.
That's the whole, that they reopened it. They reopened
until when?
Until March 31st.
Yeah, I mean, so someone's saying, hey, you can apply now for the first PPP and then go back and apply under the second one. Is that doable?
Well, you'd have to fully exhaust it prior to your round two.
Thank you. I knew the answer. I just wanted to have you say it because I think you got to think it through. Some of the rules are going to really prevent someone from maybe getting 2 loans at this point and being able to use it. So.
Yep. Okay. Streamline. Okay. So you talk, yeah. So good. So eligible costs. And we talked about this. This is in the slides. I know we're running late here. So, but just be aware you've got these new, and my understanding, and I will try to get this in a bold statement with an asterisk in red on the slides that you guys get it. And, you know, I might not get it. You know, I won't get it up till next week. But I think that these new expenses actually go back to your round one loans, right? So, like, I've got a client that somehow they were able to get a loan that they really couldn't spend during 24 weeks, even under the, you know, even under the 24-week period. And they had a lot of questions about you know, whether this or that would qualify for utilities. My understanding, and I've heard another person say the same or write the same, is that this goes back, right? So if you have, you know, supplier expenditures or worker protection expenses, and they're all defined in the next slide in detail, you can go back and claim those for purposes of your forgiveness for round one. That's going to help some folks out, probably not too many, because I think everybody else, you know, for most part, 95% of the people had, you know, spent way more than they could have ever gotten rid of, right? Because the loan was basically for 10 weeks of payroll and you got 24 weeks to spend it. So I will get that confirmed. I know I read it somewhere. So here's your definition of all these new expenses.
Yeah, Bill, this is really helpful. I think people can take this slide and then apply it to their situation.
Yep. Oh, there you go. I said it right there. So I must have read it somewhere. I read it somewhere. But I'll note it where I'll cite the provision in the act so that folks can, you know, have some clarity. But I don't know how many people it's going to affect. Like I said, I have one client. It will definitely impact them, and to a pretty significant degree.
Wow. So, that was a lot, Bill.
Yeah, a lot of material.
We had a lot going. We still got 65 people. That's pretty impressive. We're 15 minutes to almost 20 minutes over the allotted time. I don't know. If I was listening, I would be on my third Macallan 15 at this point. But listen, Bill, I got to just tell you, and you know me well enough to know I don't blow a lot of you know what. Very impressive, Bill, what we've been able to do, and mostly you. And dropping this down in short notice. I think we've got another 1 or 2 in us probably coming up, maybe a deeper dive. I think people should let us know feedback wise what they want to learn more of. Maybe it's the employee retention credit. Maybe it's more on some other stuff. I really think there's a lot here for people to make sure they just not miss. and there's been a lot of questions on the ability to go back and calculate the employee retention credit and how to do it and what's an employee, there's a lot of detail and we can't get into everything. I think we tried to get into a lot of depth to put you on notice that we don't want you to miss the value associated with what's been driven in this new guidance. Go back, take a look, use your advisors. That's what we get paid for. And really try to maximize the ability to, if you're struggling, take advantage of it, survive as a business, get to the end of the fall, get to the end of the spring, and hopefully we go back to normal. So we've got our contact up there. We've got our website up there. Please don't hesitate to reach out to us. Bill, any closing words of wisdom for the group?
Yeah, I just want to, a comment I kind of forgot to make on the PPP tax deduction. Right, we're good on federal, but make sure that you talk to your advisor about state tax consequences, because the states may not follow federal treatment. I've done a SALT webinar where we talked about that. Maybe that's another piece of a webinar we can do, but it's, you may have a state that says, hey, we conform to the Internal Revenue Code that was in place as of 1/1/2015. Well, they may not take the same position. So you may have a little bit of a payback there on the state side, but probably the minority position, but just be aware of it. And again, I'm glad that, we'll get a chance to go through the questions. I hope, my intention of really emphasizing that employee retention credit, or as I like to call it, the ECR. I hope people pay attention to that, because it's I think there's an opportunity there, and I hope folks can take advantage of it. And Bill, we'll try to do another. What's that?
No, go ahead.
I was just saying, we'll probably try to do another one that will be, I think a deeper dive on that might be necessary, but also like a one that has nothing to do with PPP and nothing to do with the employee retention credit, but just making sure that folks are aware of the qualified improvement property, other like pure tax things that they just need to be aware of, or at least make their advisor aware of. Just because those are out there, they're aged, they've been out there for 9 months, but obviously we're in tax return season, so they should be on the kind of the front of folks' minds.
Hey, Bill, for the people who were able to stay with us way over, we're going to say, if once we hand out the slides, if you can identify all 40 of Bill's misspellings and ERC versus ECR, you'll get a free hour with Bill Claffey, listening to him play his guitar. He's a big Pearl Jam fan, so we listen to Bill rip up some Pearl Jam if you're able to win the prize and identify all of Bill's missteps in his presentation that he did at 2 a.m. In any event, Bill, this is great. Appreciate it, Bill. Well done. Everyone, thanks for doing it. We'll get the slides out. I know people are eager on the slides, Bill. So okay. They're really asking how quickly they can get the slides. So we'll do our best to get them out and get the recording out. And for all of you that have kept with us longer than normal, thank you very much. If you saw Bill and I struggling to get to hear each other on the webinar about 2 seconds before we went live, you would appreciate how calm we were when we went live with the webinar. So thanks again, everyone. Have a great day. Have a great weekend. Talk to you soon.
Thank you, guys.